Have you ever wondered how someone could lose more money than they originally invested? It all comes down to one big mistake: trying to save a sinking boat. I didn't pay attention to position sizing, and before I knew it, that was it. I was over leveraged. The boat was sinking fast. Instead of jumping out with what I had, I tried to save what was in my room. But in the end, I lost everything, both my investment and the money I had in my hands. Experience teaches us hard lessons. Today, I will unveil the mistakes I made so that you can avoid those in the future. Not taking profits. Guys, if you have any profits, you have to take a little bit of them, like you do DCA or dollar cost average. You have to do the same, but when you sell, alright? I was up at least 10% in all of my investments, but I didn't decide to take them. It all went down and it was catastrophic. I didn't know about all the options I had to save the position. Those were options such as hedge mode and assets I could use as a margin. It is therefore crucial for you to research the marker you will operate on and all the possibilities. I am not saying to go in the theoretical loop and never go and experience with practice, but you have to learn the basics at least, and then you gotta put them into practice. Entering a position just because it seemed like a good play. So this is kind of like FOMO, but not completely FOMO. So I just saw a position. I was searching for some assets and I saw this asset that I liked and the position seemed right. But I didn't analyze with technical indicators, I didn't analyze candlestick patterns, volume, I didn't analyze anything at all. I didn't even analyze about the asset I was investing in. So you gotta do those things. Not using stop losses. This is the most, and I repeat, the most fatal mistake I could have ever done. While there might be big players and manipulators in the market, this will be useful either ways. For example, let's suppose that a big market player made the market go beneath your stop loss, and then it went 2 or 3% lower to continue going up afterwards. While you lost some money, you can now try to long it again from the new dip, and therefore you have another chance. But if the asset really plummeted, you are covered, right? So that big manipulations do not happen to you. You have to analyze the bigger picture. You have to see some patterns about how people manipulate the markets. And then you will realize that at a bigger picture and you will be hesitant to trade in lower time frames using cross margin. This is not necessarily a mistake per se. If it's well used, it is a great tool. But it was a mistake, since I am a newbie. I did not know about some hidden stuff and behaviors of the futures market, and yet I thought it was a good option. I accept that it was a good option from my perspective. I still think about it, but the big problem, and it everything relates to basically, it was not using stop losses, adding to a losing position. If you already have a stop loss, if you add to a losing position, then you are making a childish decision. You have to recognize that it will be a big mistake. Yes, you can take another position in the same asset after if it falls down even further, but that doesn't qualify you to skip the stop loss in the very first entry, and not in the second either. Sure, I will make more mistakes in the future, but the key is to learn from them right now. Remember, even if you hold too long, a stop loss will save you from that disaster.